Welcome to today's webinar on construction conditions. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Ron will be entertaining questions at the end of his presentation. If you have a question, please type it in the chat box on Zoom. We'd love to get your feedback at the end of this presentation, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. With that, I'll turn it over to Ron.
Thank you, Haley, and good morning, everyone. I appreciate everyone coming to this webinar this morning. The weather of late kind of really reinforces the utility that we start getting out of these webinars. So I appreciate everyone taking the time on Friday to come and listen to some results from our most recent construction survey, which we did in November. I think there's some very interesting things here, and hopefully everyone will learn a little bit here. We also will be looking for questions at the end, so I'll be looking for questions in the chat box for later. So before I get started here, I need to give you my disclaimer. So the views expressed here are those of mine and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So first, before I get started, and for those that are repeat viewers, first, thanks. And for those that are maybe new, I just want to give a little shout out to my partners and to respondents that may be watching here. So for those that aren't familiar, we do this survey through a lot of construction and trade organizations that are across the 9th District, and we have some in every 9th District state. They help get our surveys out to construction firms out in the district who respond to our surveys. So they're really key in this effort. This is the largest construction-focused survey among the 12 Federal Reserve District banks. So again, I think that's a really big deal that we have so many people involved to make that happen here. So just a really big thank you. The information that comes in really provides the Minneapolis Fed as well as our partners and their members with a lot of insights on current conditions. We not only have partners distribute the information, but we also give a lot of that information back to them, a little bit more even than I'll present here. And I'll talk a little bit more about that at the end. So a little bit about the construction survey itself. We conducted it from November 7th to November 18th of this year. We had 276 respondents, most of them in Minnesota and especially from the Minneapolis-St. Paul region. I want to remind, as I always do in this webinar series, the results that we get because of our methodology, these are more of a snapshot. It's not a scientifically sampled survey. In terms of who responded, there are four. We break down the groups in 4 different sectors of the construction sector. 55% of the respondents are working in the non-residential commercial sector, and that's non-exclusive. So you could check a couple of different boxes among these 4, so that's why it adds up to more than 100%. And then 45% of respondents have some work in residential, and then 20% and 16% in infrastructure and industrial. The one thing I would note in terms of the last 2 categories, while we have a smaller sample of those, they tend to be much larger firms, and I'll talk a little bit about that later. So they represent a larger share probably of total activity, but a smaller share of the firms that responded, if that makes sense. Again, because this is not a scientifically sampled survey, please interpret the results that I offer here with some care. So some quick takeaways just to kind of set the tone here. Revenue is trending negative. I think probably not a big surprise to a lot of people listening, and it's also not trending negative for everyone. Profits are widely lower, however. Residential is seeing significantly tougher conditions as it relates to our respondent base, and industrial is actually seeing the best conditions. And I'll kind of profile a lot of these results further on. There are a fair number of future concerns. So we're seeing an increase in project cancellations mostly across the board. We're also seeing a reduction in backlogs and in new projects out for bid. So there's a lot of challenging conditions still, and I'll talk a little bit about that because some of the same candidates as before, but we've also got higher interest rates added to that mix. And the outlook overall has declined, but it hasn't actually fallen off the table. So it's actually, after I get through, you maybe think that the overall outlook might be a little bit more negative than it is. It has declined, but hasn't maybe declined as much as we might expect. So let's talk about some of the individual categories. So recent revenue and profit trends. First, let me orient everybody to how if you're new to this webinar, how I generally orient things. So I will often compare over a number of different time periods. And in terms of the response, red means bad, green means good. And the darker the color, the more heavily weighted that area. So it's either significantly negative or significantly positive. And here, the first question we ask, the first content question we ask our members is that whether to compare revenue over the last 3 months over 3 different time periods. So the previous 3-month period, that's the top, and then the same compared to the same period a year ago, and then expected future. And what I take from this chart is that quarter over quarter, we're seeing some negative revenue trends. Not terribly surprising. There's likely some seasonal effects embedded in that. I think a better comparison is the same period a year ago. That's also flat overall, which I'm going to show you a chart shortly here. Overall revenues are actually still quite high. We are, however, seeing a larger share that are seeing a big decrease, excuse me. So the overall share compared to a year ago, we have about the same number, same share that is seeing increases versus decreases. We are seeing a little bit larger share seeing a big decrease though. So I think that's notable. And then I think, again, I'll talk more about kind of what looking ahead. Expectations for the coming 6 months compared to what was last year, their expectations last year are decidedly more negative. So I mentioned that revenues overall were still up, but we do get a lot of other data that try to kind of triangulate what the trends are. And Dodge Data Analytics gives us a lot of good data, and this is over a 5-state region. And generally what we're seeing there, what I do is I do a 6-month rolling average of the monthly value of new construction starts. And what you can see is that things are still trending fairly good. Total construction spending is still high. I think that's probably boosted by the fact that we have higher pricing. We know that inflation is very much a factor. This is also probably colored a little bit by strong activity in South Dakota and Montana. They happen to not be very well represented in the sample. So whether, if we had more South Dakota and Montana firms, I don't know exactly how the survey results would change, but I would say overall spending is boosted by the fact that activity there, especially in places like Sioux Falls, really is quite strong right now. So turning to company profits, which is obviously a very important factor as well, we are seeing a little bit more negative trend in this overall. So across the board, the last 3 months compared to both quarter over quarter, year over year, and then expected future profits over the next 6 months, all net negative. And the expectations, for the coming, I think, is really the one that we're kind of interested in maybe most on kind of what lies ahead, and that is the most negative of the 3 measures. We've been doing this survey for some time, and I also like to take a look at how certain questions are trending over time. So this is called a repeated cross-section. And so this chart shows you the year-over-year revenue comparisons going back to the survey we did in February of 21. And you can see that from February 2021 through November of last year, things were generally trending more positive. Fewer firms were seeing net revenue decreases. Many more were seeing revenue increases. Okay, and then what we saw in April and again here in November is that we're seeing that year-over-year trend go more negative. Not crazy. It hasn't fallen off the shelf, but we are seeing that trend to a little bit more compression to kind of almost a barbell kind of, where we have equal negative and equal positive on the opposite sides. So now I'm going to start talking a little bit more about the different sectors. A lot of the rest of the presentation will feature how different sectors seem to be performing. And again, I want to caution everyone in terms of an interpretation. In some of these, we're talking about fairly small sample sizes in terms of the number of firms responding, 40 to 60. I do see a lot of consistency in some of the responses in terms of how other factors might also look. So I think this is a reasonable snapshot, but again, interpret with care. So what we've seen generally is that the year-over-year trend is much more negative in residential. The other sectors are actually reporting year-over-year increases, not huge ones, but it is more positive in the other 3. And here's where I'll also mention that size factor. 60% of residential respondents had sales of 10 million or less. And that matters in part because what we've seen through all of our survey work is that during the pandemic, when conditions change and things become more volatile, small firms generally have performed more negatively than large firms. I think there's some I don't want to call it a simple reason why, but if you are a firm of larger size, you tend to have better resource to adjust to volatility. That's what we've generally seen during the pandemic. That seems to be maybe the case here, where there are a lot of small residential firms that are having more difficulty in this admittedly very volatile kind of environment. Infrastructure, just for comparison, is doing better. They have many fewer small firms. Only 30% of those respondents had sales below 10%, or excuse me, below 10 million. So in terms of expectations for the coming 6 months, again, I think it's an important indicator. Residential here, more negative. There is growing concern, I think, across all of the sectors. Outlook for industrial, though, still moderately net positive among the four groups. So if we look at some other metrics of current and future activity, one of the things that I would look at is, and one of the things that we've been tracking, are project cancellations. And we are continuing to see, so it really was trending slowly lower and pretty decent through November of last year. And in the last two surveys that we've done, we've seen a fairly significant uptick, actually a bigger one in April, but a continuation of that higher trend. And it's really quite negative in terms of the share that are seeing cancellations decrease versus increase. We are seeing more pulled off. In reading the comments, and there are a lot of them, the respondents really give us an awful lot of qualitative feedback. And my sense is that the cancellations are happening because of cost inflation. So projects are getting more expensive and they're taking them off the table. There are also higher financing costs because interest rates are higher. And then there's just general uncertainty in the environment. Again, if people are expecting recession down the road, again, that I think probably changes the calculus of whether or not they want to move forward on a project. Again, broken out by sector, not surprising given some of the previous charts that I've showed you. Residential is seeing the highest cancellation rate among all of the sectors, but again, all of them are seeing, I would say, a negative overall trend. Industrial being the narrowest. So we're also looking at what projects are out for bid, the future pipeline of construction projects, also called requests for proposals. And so what we're seeing right now, we ask it on two different levels: RFP for public projects and RFPs for private projects. And what we're seeing now is that new projects out for bid, those requests for proposals really have shrunk fairly noticeably. And it is more so for private projects than public projects. That's a little bit of a reversal. Earlier in this survey cycle, we were seeing that RFPs for private projects was much more positive than it is now. So we're seeing much more of a shift in that for private projects than public ones. Again, I think that's driven largely it is driven mostly among all four, most by the residential sector, which you can see here on the left chart is really quite negative. In terms of public projects, it's a lot more even. In part, I think there's only certain projects that will go in public projects, say for residential, even though that is also high. But we are seeing generally across the board some fairly negative trends in terms of RFPs. We also started asking this survey about the backlog of future projects and other work compared to the previous year. And again, here we're seeing firms chew through more of what their backlog was. So I think what you can see here is that it's fairly even among infrastructure, non-residential, and industrial, and significantly negative in residential. I think very likely it's from the fact of the other charts that I've showed you. There's higher cancellations, lower RFP levels, and firms that are seeing those things. So if there's a cancellation and there was something in the backlog, they're pulling that work forward. And so I think that's one of the reasons that we're starting to see lower backlogs of future projects. Hopefully that can get regenerated, but that's where we are right now. So challenges. I think everyone in the audience is probably familiar with these. These are things that I've been talking about really since the start of the pandemic. There is still really the big three of challenges: labor, inflation, and supply chain. Those are the bars on the right. What you can see is that labor availability and supply chain disruptions, the bars in the red, we have seen a little bit of a lessening as to whether or not those are the greatest challenges. Doesn't mean they've necessarily fallen as a challenge. What I would say is if you look at the other bar, higher interest rates, this is the first survey where we've included higher interest rates as an option to choose. And a lot of them are almost 30% chose that one as a great challenge. So I think there's not necessarily the reduction necessarily of labor and supply chains being a problem. What we know though is that higher interest rates are also becoming an increasing problem. And I think especially for residential, I think that's also why you're starting to see that. We know that the residential market is a little bit more sensitive to interest rate increases. And so I think that's one of the reasons why we're seeing that show up as high as it has in this survey. One of the big challenges that remain, inflation, rising prices. And the good news here is that if there is good news, I would say retail prices have downshifted, but they are still very high. And in the circled boxes there, I just wanted to point out that in April we saw a spike in terms of those. We really saw the answers shift to the right in terms of higher increases in prices. And what we're seeing on this survey is more of a shift to the left. So we're seeing fewer firms report really dramatic increases. Now, they are still a number of firms that are reporting big increases, and even 10 to 25% is a lot. So I don't want to say that prices are lower or prices are in a good place, but I would say the trend has at least started to ebb, at least according to this survey and our respondents. And that's not only from a wholesale, so the chart on the left is from wholesale prices from vendors, and then the retail prices to customers is on the right, and they're both seeing generally the same trend. Not exactly, but the general trend is the same. A higher increase in April, and then a falling in November in terms of the highest category. Whether or not things are getting worse, so we're interested in kind of where things like prices and other things are right now. We're also interested in the trajectory. Are things getting better or worse, basically? And what we're seeing on these four main challenges is that higher interest rates are very clearly getting worse for some firms. Material inflation is also still a major issue. I wouldn't say we're seeing relief yet in supply chain or labor, but they are getting closer to maybe starting to ease a bit. The good news, in my opinion, is that labor force demand still remains really quite strong. It is taking a small step back, but I would generally say we are seeing something that is well within the margin of error over the last 5 surveys, in terms of what labor demand firms are telling us out there. So there's a really persistent and solid signal right now. Industrial is stronger, residential is weaker, but they are still hiring at a fairly significant rate. I think we have to be honest about kind of what's beneath the hiring demand. I think some of it probably is the fact that a lot of firms are still having a lot of trouble finding labor. So that persistent inability to find labor is also probably kind of sustaining demand overall. In terms of overtime, here is I think the better signal. So we ask about hiring and staffing demand over the coming 6 months. We've done that for the last 5 surveys. And here is where there seems to be a little bit stronger signal about maybe some pullback in terms of hiring. Now in November, what you're seeing is that this could be a seasonal effect, because a lot of construction firms do tend to lay off some workers as this winter season tends to be a little bit slower. The thing is, if you go back to the November 2021 survey, there isn't the same signal present. So we were still seeing growth in November 2021 in terms of expected new hires. We're not seeing that, and there's a little bit of a pullback from both the April and compared to the November survey. So I would say this is a little bit of a weaker signal in terms of overall labor demand. Then we also have labor availability. What I would say here is that, again, we're seeing some modest improvement in labor availability. I think we have to attribute at least some of that to the fact that we're seeing softer business conditions in general. Despite the softening, though, I think you'd have to say that labor conditions really still are still quite tight. You still have 80% of firms saying that they're having at least moderate or very tight labor conditions for the open positions they have. In terms of wages, still high. I think we are seeing some evidence of some softening. So let me just point out two areas. So the little chart on the left is the April. And what you see there is, again, a shift to the right in terms of wage increases. So the tan bar is for the last 12 months, and the green bar is the projected over the coming 12 months. So in April, firms were saying that they expected wages to continue increasing. What the chart on the right, the November survey, says is the exact opposite. It was increasing, but we expect slightly lower. We expect about a 10 percentage points the number of firms, the share of firms is 10 percentage points lower in terms of those that expect a wage increase of 5% or more. So again, I think a signal that maybe some softening is having some effect on wages. I wouldn't call it major in the sense that we still have well more than roughly about 60%, a little over 60% that are still projecting increases of at least 3%. In terms of the outlook, and this is what I mentioned earlier, in that I wouldn't say that I'm giving you a particularly optimistic picture of what firms are telling us about their own prospects going forward. But then when we actually ask for the outlook, I wouldn't say it has fallen. And I'll point to a couple areas. Really what we see is the share that went from somewhat optimistic to somewhat pessimistic basically shifted. So it has turned more negative, more pessimistic. But if you look at across the boards, if you took out all of the other bars, right now it is essentially flat. So there are an equal share of firms that are optimistic versus pessimistic. So I would call it a very flat or mixed kind of outlook right now. And given kind of the current conditions, I actually think that was better than I probably would have expected otherwise. All things, had I guessed at this before while looking at all of the other survey results. In terms of the outlook in general among the sectors, again, residential, not surprising, has the most negative outlook right now for the next 6 months. In terms of the other three sectors, all net positive. So I think that's really something to take home in terms of where we are in construction markets overall. We know that residential is seeing more difficult circumstances because of their client base, but we are seeing a fair amount of optimism still in the other three sectors. And again, from a size standpoint, we see larger firms in here. So in terms of overall construction activity, overall construction spending, this is actually a fairly positive outlook among the other three. So real quick wrap up. So again, revenue is trending negative, not for everybody. Residential really has been the one that is seeing the toughest conditions. We are seeing profits that are widely lower. That's obviously a concern for all firms. Industrial, I think, is really still in a pretty good spot right now. Again, the future concerns for me are the increase in project cancellations, the reduction in backlogs, and new projects out for bid. That's the future. That's the future work that we want to pay a lot more attention to. And we know that challenging conditions still persist. And unfortunately, we've added interest rates to the mix, which kind of really compounds a lot of things. Hopefully, we can get, because of the higher interest rates, we can get a little bit better handle on the inflation part of the challenge, which might help other areas of challenges. But again, that's something to be seen. Outlook has fallen, but again, from my perspective, maybe not as much as we would have expected given the circumstances. So I'm going to get to some questions really quickly, but I just want to let everyone know about other Fed surveys, especially when there are volatile conditions. I think we do a lot of surveying. I hope people find it useful. We do a monthly business pulse survey. Just that's kind of FYI. We don't publish anything on this. We're hoping to once we get enough of a time series going on this. But if you ever get this survey or if you're interested in participating, let us know. We're trying to really build our sample base on this. Then we also do a lot of quarterly surveys, ag credit. We do a hospitality tourism survey that just is finishing up. We also do biannual surveys, including this one and a general business survey that will be going out in January. And then we do annual surveys on manufacturing, professional services, and childcare providers. And then we also have this new area, not necessarily is new anymore, but it's still kind of in an ad hoc kind of space where we're really trying to better understand what's happening to labor force participation. Labor is obviously an issue. The audience here knows that. We're trying to learn more about why labor force participation is not bouncing back like we would hope. And if you're ever interested in more info on these surveys, minneapolisfed.org has a wealth of information, and you can contact me. You'll be getting this slide deck afterwards. I'm happy to get any contact from people listening about information that they might want on any of these surveys. And if you are looking for more engagement, if you happen to be the head of a construction association or part of one that want to be involved, we're always looking for new partners to help us gauge current conditions. What I would say is partners and their members get more detailed response data, so we give back a lot more information than I'm able to cover here. I'm always willing to share if people ask, though. And I'm also available to discuss these findings directly with new construction groups or existing ones, your boards of directors and others interested. Really just how the construction sector is faring right now, because when I can get in front of an audience, I can also learn from them too. So I'm really interested in more outreach to anyone interested in more of these findings. So with that, Haley, I would be happy to take some questions. I'll leave this up here just for some contact information, just for a little bit, then I'll stop sharing, and we'll be done shortly.
All right, sounds good. So if you have any questions, please type them in the Zoom chat box. We can start with this one. It says, as many in the audience probably know, the Fed raised the benchmark interest rate by 50 basis points at its FOMC meeting this week. What else came out of the meeting that our audience members might be interested in?
Sure. So as I mentioned, interest rates really did pop out as a new challenge, especially among residential firms. It's important. What the Federal Reserve is doing is important right now. At its most recent meeting this week, the FOMC increased the target range for Fed funds by 50 basis points. So it's now up to 4.25 to 4.5. So where do we go from here? It's very hard to say. I hope audience members understand that, the handful of increases that we've already seen, they tend to have a lag effect on their intended targets. So we're really targeting inflation and economic activity to some degree. But we don't know exactly what, like the most recent 50 basis point increase, what effect that will have. And that's why the FOMC, will really monitor a lot of current conditions leading up to the next one. It's also why these surveys are so important in terms of us trying to get a better on the ground feel for what conditions are like. But I guess what I would say is I really want to stress that the Fed and President Kashkari in particular is really committed to returning inflation to its 2% objective. We have seen some recent inflation data that suggests some favorable and downward pressure on prices. But Fed Chair Jerome Powell in the press conference and I think just generally has been really communicating that the committee would need to be very confident in the path of inflation towards that 2% target before before monetary policy did any notable pivot in terms of its current approach. So I wish I could have a more definitive answer, but we really are paying a lot of attention to current conditions, not only in the construction sector, but across the rest of the economy. Unfortunately, construction is probably the first and foremost industry affected by interest rates. So that's why this survey in particular is so important, and we really appreciate everybody's feedback on it.
Great. And we did have quite a few questions about the categorization of multifamily construction and single family construction and where that goes in, if it's multifamily is commercial, residential.
Yeah, unfortunately, I can't say exactly because even people that like at the city level that take permits actually can categorize it in different ways. We let people self-select. My impression is that those that are doing multifamily probably select both residential and non-residential. It is often considered non-residential in a lot of real estate reports, from real estate research firms, but it is often counted as residential if you were to be looking at permitting. So I can't tell you exactly what the share is. What I can tell you is we've seen a significantly larger decrease in the permitting activity among single family residential. So I'm inclined to say most of the people that are saying residential are single family, in part also because multifamily tends to be or is still really quite active. And that's also why I think the non-residential sector, more of them that are in multifamily are probably checking the non-residential, because that market in general seems to be, and the respondents were more positive than the residential overall.
Perfect. And it looks like we have time for one more question. So someone asked, can you define backlog a little bit more and say more about its significance?
Yeah. Because we don't want to make surveys too onerous, we don't define backlog. Basically, I think there's a general definition of basically if you have projects that are already booked, but we don't actually use that definition. We kind of let respondents fill in what the definition is, what they consider, because we generally think of backlog as expected work. And so we use that as just kind of a general definition. So if you are expecting work, whatever your definition was this year, it was the same last year likely. And that's really what we're trying to get at, is people's own understanding of what something might be and what does that look like over time. It would be useful. It would be good to get more specific on a lot of these things. But what we found is that the more specific and the more onerous the survey, the fewer insights we get from people. So that's kind of the unfortunate trade-off that we've decided to make on some of those matters.
Great. Thanks, Ron. That's our last question for today. Thanks so much for joining us. Also, as a reminder, we have our annual Regional Economic Conditions Conference on Friday, January 13th. More information will be in our follow-up email to this event. And please remember to fill out the brief question survey that will pop up in your Zoom window upon exiting. And hope everyone has a great day.
Thank you, everyone. Good luck and happy holidays.